Good afternoon and welcome to the Menhaden Resource Efficiency PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Ben Goldsmith, CEO. Good afternoon, to you, sir.
Thank you so much for hosting this. I'm sorry to interrupt with a technical question, but I don't know how to change the slides. My ability to do it has just come back. Thank you all very much for attending this. We're really grateful that you're taking the time. We've got a presentation that we're going to take you through relatively swiftly to make time for a discussion, for questions, and so on. If at any time you want to put a question, put it in the right-hand side, and we will answer it. So I teamed up with Graham Thomas, former chairman of the executive committee at RIT Capital PLC in 2015, with the idea of launching an investment trust that would be, let's say, green slanted, so that would play into what we think is the most interesting megatrend taking place in the world today, which is the move towards the far greater efficient use of resources and energy and so on, move towards renewables, the green industrial revolution, if you like. Now, I'd always hugely admired RIT, and we wanted to emulate the best characteristics, not just of RIT, Caledonia, and some of the family-controlled investment trusts in London, but of my own family office and others, which have permanent capital, which take a long-term approach to investment, and which are able to flex their asset mix according to how they see the world at a particular time. Now, we think the closed-ended structure it lends itself to a really successful approach to risk management, generating risk-adjusted returns. So we completed an IPO in July 2015, and Luciano, who you see on the screen, joined as our CIO a year later. So we had a little bit of a rocky start, and we developed with Luciano a new investment policy which revolves around quality and value. So what we did was look to a kind of Buffett school approach of quality and value in a concentrated portfolio applied to this green industrial theme, and that has been working out. You know, that we're here now 8 years later with a track record more than 10% net of costs annualized since that time. Market cap of a little over 80 million. It should be far higher, and we're going to devote a chunk of this conversation to that crucial point. But net assets of 140 million, which have substantially more than doubled since Luciano joined us. So Graham is still with us as our chair, sort of half a day a week. We have Luciano and I are effectively business partners running this investment trust, and then we have a super analyst, Edward Pybus, who's been with us for a number of years, who reports into Luciano. And investment decisions are taken by unanimity. The board is chaired by Howard Pearce, who ran public sector pension funds for a long time, who ran the top performing Environment Agency pension fund for a number of years. He took over as chair from Ian Cheshire, who remains on the board. And the reason for Ian Cheshire was that he was chief executive of Kingfisher PLC, the owner of Castorama and B&Q. And alongside Stuart Rose, who was then at Marks and Spencer, Ian was one of the first FTSE 100 chief executives to really understand this point about energy and resource efficiency, and that investing in green technology saves you money. I remember at the time, particularly Stuart Rose at Marks and Spencer with his plan A, with the strapline, because there was no plan B, was pilloried in the media and in the city for investing so heavily in things like LED lighting and efficient trucks and more efficient refrigeration and so on. But in fact, plan A paid for itself very, very quickly out of the savings on their energy and resource bills. And now this is mainstream in pretty much every industrial sector. Soraya Chavarek at CQS, she runs CQS for Michael Heinze, and Barbara Donahue used to run the family office of the founders of Gap, the clothing company. The board is, of course, independent and subcontracts management of the portfolio to us, Luciano and me, in our management company. So the idea is multi-asset, which we're able to do because it's a closed-ended vehicle, with an emphasis on capital preservation through a long-only approach. And as we put it here, seeking best balance between risk and reward across equity, credit, and private universes. This is a Buffett school approach, and we'll talk more about the lens through which we make our investment decisions. This is really a US and developed markets fund. We technically can invest anywhere, but given the conservative nature of our approach, we're in the obvious places. And we always intended a concentrated portfolio. So at the moment we have fewer than 20 positions. I don't think we've ever held more than 20 positions. And the highest conviction positions have at times been significantly more than 10%, at one stage north of 20% in a couple of cases. And very low turnover. We buy stuff for the long term. So it's a patient approach targeting long-term capital growth with low volatility. And the thesis primarily revolves around this theme of accelerating disruption. You would scarcely believe 10 years ago the pace of change, for example, that's taken place in power generation. Solar has gone from being sort of an eccentricity or a kind of fringe source of power to becoming the cheapest source of power that the world has ever experienced, and by far the largest participant in all new powered infrastructure that's being built. And the solar has completely disrupted coal and is in the process of disrupting natural gas as well. Similarly, competitive moats are under siege. The period in which businesses hold the top spot, it gets shorter with every passing decade. We're going through a period of tremendous disruption and growing risk to terminal values. And we think a lot of that revolves around this energy and resource efficiency theme, which is broad, and it cuts across a number of different segments. We're not just a renewables fund. Now, the way we described it in our prospectus was, we'll invest in businesses which either deliver or meaningfully benefit from the more efficient use of resources. So this is the little Venn diagram that we drew in 2016. Anything that we consider has to fall within the category of resource efficiency. If you're a manufacturer of microwave ovens and your microwave ovens use less power than the rest of the market, then that's a fit for us. And we'll explain in the context of some of the positions we hold why they are considered by us to be resource efficiency plays. Value, or really this should say valuation. We're kind of mindful on valuation in the Buffett school, and quality. And we want companies that have strong balance sheets, which have cash flows that we can understand and that we can predict with some degree of comfort. Companies which are going to be around, we think, for the foreseeable future, because they have strong competitive positioning. They benefit from high entry barriers, and it's a bottom-up approach. We don't look at this from a top-down perspective. We don't decide how much of the portfolio we want allocated to waste or to energy. We have a bottom-up approach. And these are the core resource efficiency themes that interest us. Digitalization, big tech has done very well for us in the last 5 years. By way of an example, the artificial intelligence technology developed by Google, DeepMind, has enabled their data centers to become radically more efficient than all others. Sustainable infrastructure and transport, we like the North American freight railroads. Transporting stuff by freight railroad is 4 times more fuel efficient than doing so by truck. And so on. Industrial emissions reduction, it's obviously a core theme in the world today. Water and waste management, clean energy, and environmental reporting. So these are kind of the broadly defined 6 segments in which we are interested in investing, or in which each of our portfolio positions falls. So here are the largest positions in the portfolio as at the end of March. So Airbus, aviation, you'd say, is not necessarily a green theme. We're not an ESG fund. We're not an impact fund. We're interested in energy and resource efficiency, and the fuel efficiency gains that have been delivered by Airbus in the last decade knock the socks off anything that's been delivered in terms of internal combustion engine cars, for example. Huge leaps forward in fuel efficiency. Our assumption is people will continue to fly, and so we want those planes to be on a trajectory of greater fuel efficiency and decreasing emissions. And Airbus's work on fuel efficiency is hand in hand with the work of Safran, which is one of the world's leading aviation engine providers. Alphabet, I mentioned, is it's the among all the tech businesses, it's the largest buyer of power, an enormous amount of power, and 100% of the power that it buys is renewable power. And also they've got a number of different other bets and technology development projects within Alphabet that are of huge significance to the green industrial revolution, such as their AI, such as their self-driving technology, Waymo, and so on. And there's a similar kind of story within Microsoft. So each of these businesses falls within our thematic area of interest. And if you look towards the bottom, we have private investments with TCI, with in John Lang, and we've recently exited our largest and longest standing private position, Excelio, which is a solar power developer and operator. We apply the same program to all of our private deals, with the exception that with the additional criterion that we must co-invest with a lead investor who knows what they're doing and who has specific expertise in private infrastructure-like or private credit investing, that is a global name on whom we can rely as a minority co-investor. So we've co-invested 4 times with KKR now. We've co-invested with TCI twice in private credit markets. We've co-invested with Apollo, the New York-based real estate and infrastructure private equity firm, and we've done so largely on preferential terms. So we don't have the team, the depth and breadth in the team to lead private deals, but we have a spectacular network, and we're able to get into these off-market private investments, which I think are one of the big differentiators for Menhaden. You know, our ability to co-invest with some of these other firms is it's worked really well for us, produced great returns, and in deals that fit perfectly with our way of investing. So the discount is mad, in our opinion. You know, given the performance track record, you know, we've compounded at approximately nearly 11% net of costs over 8 years, and it's working. You know, what we're doing is exactly what I envisaged that we do, which is invest in a conservative way, protecting investors' capital and producing stellar returns. We're among the best performing investment trusts in London. We're not large. We have assets under management of 140 million, but we're compounding our way to scale and liquidity. And so the purpose of this call really is to figure out, you know, what people's views are on the discount and really to promote the investment trust among potential new buyers. I want to pause at that moment and invite Luciano, my colleague, to pick the slide that allows him to talk in more depth about some of our largest positions.
So if you look at the portfolio, you'll see that large listed companies like Airbus, Safran, Alphabet, Microsoft, VINCI, etc., represent a big portion of the portfolio. We currently could divide the portfolio effectively in 4 buckets. The first one would be tech and aerospace. Between the two of them, that would represent approximately 50% of the portfolio. And those are companies with high pricing power, big moats, and with operational leverage, which is very important. The rest of the portfolio probably will be the private bucket, which at the moment, if you look at the bottom, represents approximately 8%. We envisage now with the addition of Avantus, you see that there's 14% cash. Right now, when Avantus will be funded in the new deal with KKR, the private portfolio will jump to close to 20%. There's also another check that we are sending to the TCI Real Estate Credit Fund 4, another 1.2% approximately. And the rest is probably infrastructure on a listed format. You see Canadian Pacific, Canadian National, Union Pacific, VINCI, and Ocean Wilsons. And I think that what we have to mention about the whole portfolio is that the fact that the low risk approach that we take. They are companies with because of the quality, we have high visibility of earnings in the next 4 or 5 years. And in the case of big tech, with Microsoft, Alphabet, and Amazon, this high predictability of earnings with cloud. In the case of aerospace, just to give you an idea, Airbus has a 10-year backlog in terms of orders. And we see a blended return currently on the whole portfolio, including the listed and privates, of approximately 10%. What we've done recently, we exited materially some of the listed positions. We reduced Airbus, Alphabet, Microsoft, Amazon, and Safran, and we built the cash, the 14.2% position that you see at the bottom of page 11. And in order to fund the new private deal. I think, traditionally we've been saying in these calls that we haven't seen the old public-private arbitrage where you could see higher returns in privates, because a lot of private equity funds were basically trying to get deals with high returns, but they were overpaying or they're putting too much leverage, and therefore returns compressed. And whenever we see the returns that seem attractive, unfortunately, they were predicated upon high levels of leverage, which makes the deal a lot riskier. So I think we're following the disciplined approach, and we have now reduced some of the listed ones at very high valuations, at some of close to the highest they've in the last 12 months. And we are starting this new position at Avantus that at very, very low valuation. So effectively, it's like we are exiting at a high multiple and we're getting to a new deal at a low multiple. And the interesting thing is that we see, in the case of Avantus, we see an IRR of approximately 20% with conservative, I think pretty conservative approach. Just to give you an idea, we are assuming 0% return on the value of the platform itself, just looking at the assets of Avantus. If we get lucky, we get the platform to be sold and people to subscribe value when they buy it, it's probably would end up with an IRR of closer to 30% than the 20% we assume. So I think it's important that in the portfolio construction that we're seeing now value on the private deals, and will probably increase from the current 20% to close to 30-35%. I think the other point to mention is the risk. I think people tend to look just at returns and don't tend to think about the risk in the portfolio. We're obsessed with looking at companies where we see visibility of earnings and revenues and EBITDA, because we think that this secular trends on specific industries, and those will benefit from very high levels of certainty, and therefore that will be translated in earnings eventually, either via earnings growth or potentially as well with multiple expansion. Then I think apart from the large ones, I think we could mention as well some of the infrastructure ones like Canadian Pacific and Canadian National, because they are a perfect example of the pricing power that we mentioned previously. The fact that even during COVID, the levels of volumes went down materially, but they managed to keep revenues pretty much constant by basically hiking prices. That shows you how much pricing power those companies have. And unlike European style infrastructure where you buy the concession, in the case of the North American railroads, they own the track, so it's a perfect hedge against inflation. I think that's kind of an overview of the portfolio and how we're thinking about the portfolio construction going forward. So I think, Ben, if you want to continue.
Yeah, thanks, Luciano. Jump to the historic NAV. So everything we set out to do, with the exception of the first year when we had a bit of a difficult time, has worked out. We this is everything I wanted to achieve with this investment trust. It's exactly the approach we settled on, and it's working out exactly as we hoped it would work out. So our aspiration is that this joins the ranks of the great investment trusts in London, the Caledonias and the Ritz and so on, for a very long period of time. This is what Luciano wanted and I want to do with our time. Is this? We have, I think, a pretty unique network and unique access to private off-market deals that most investors can't reach. We're allowed to have significantly increased allocation to private deals. As Luciano said, it could be a significant minority of the portfolio, 30-40%. And we think we're good at what we do on the publicly traded equity side of things. So I'm very happy to have my money in the investment trust and that of my family. And so we have long-term aspirations. Here, of course, is the issue. The investment trusts across the board are trading at some of the steepest discounts that we've seen in recent years. And in our case, the share price accretion has not kept up with the NAV accretion. And that's why we have a share price discount to NAV of about 40%, which is tremendous value or very frustrating, depending on what your perspective is. So for the time being, our strategy is to continue relentlessly to focus on investing in high quality businesses that meet our investment thesis, and just to continue managing risk in the way that we have and seeking great risk-adjusted performance. And we think that if we do continue to compound at 10% plus net of costs, we will compound our way to scale. And scale means greater liquidity, and greater liquidity should mean, if you look at the historic discounts of investment trusts, a narrower discount. So greater scale also means lower expenses in terms of the total expense ratio. We're already very focused on obtaining value for money from all of our service providers, and the total expense ratio keeps on ticking down with the growing NAV. So we are not among the most expensive cohort of investment trusts. In fact, we're less expensive than the others that we've mentioned on this call, and we're getting less expensive with every passing year. And we spend a lot of time looking for new private deals. So I don't know I think it might be a good moment to jump into questions, which may lead us back to some of these appendix slides, which cover our individual positions.
I think there were some questions about what you just mentioned about fees, discount, etc. I think it's quite important to mention that currently, if you look at similar closed-ended investment trust, family controlled, like Caledonia, RIT, Hansa, you'll see that discounts are very similar. I think RIT now is close to 30%, Caledonia around 36%, Hansa around 45%. Their fees are similar or higher than ours, despite being much larger than MENHADEN. So I think if you are a retail investor in the UK, probably this has never been a better time to invest in closed-end investment trusts. The risk return, the discounts basically allows you a big margin of safety. And we think obviously that MENHADEN offers a much better risk return profile with better companies and better private deals. Obviously, things like buybacks are tempting it when you trade at such large discounts. However, unlike the Caledonias and RITs and Hansa, we are much smaller, so we want to allow investors to have more liquidity and not less liquidity. I think Ben is probably very shy on not mentioning enough the fact that the access that we get. I don't think that the average investor can co-invest with KKR and Apollo and other closed-end in their private deals with such preferential terms. So I think that the value proposition is definitely there, and the low risk profile of the fund is very appealing. We don't know what's going to be the catalyst for the discount reduction. It's definitely going to take time. But while you have rates, at the current levels, it creates a vacuum, and a lot of retail investors are taking money off risky assets and putting in treasuries, gilts, etc. I think the other issue is the concentration of wealth managers in the UK. The consolidation makes it harder for smaller trusts to appear on the radar. At the same time, as Ben mentioned, I think the likes of Impacts and RIT, they started exactly like us, and I think probably they didn't have such a good performance at the beginning. So I think, as we mentioned, it's a great time to buy closed-end investment trust and be patient, because you will be rewarded.
I'd just like to jump in on this question from Andrew. There's perhaps a trade-off between the broad scope and flexibility that we seek as managers on the one hand and the clarity of message and purpose on the other. Do we think that's a factor in the discount? And I also want to read out the question from James underneath, which is that it doesn't make sense to buy into private deals with a hopeful IRR of 20% when you can buy your own portfolio at a 40% discount. How much of the trust does the family own, by the way? I guess that the main factor in the discount, in our opinion, is the size. We think that for lots of retail wealth managers and investment management firms, there is now a market capitalization cutoff beneath which they cannot buy those investment trusts. They can't be on the approved list. So we think that compounding our way to scale is the best way to breach those thresholds and therefore enable the large wealth managers to start buying us. We're not, if we compound at 10% a year, if we compound at that sort of rate, then we're not many years away from having $250 million of assets under management, at which point we're starting to get into the size bracket that enables those firms to buy us. So a buyback, as Luciano mentioned, takes us in the opposite direction. It shrinks us and it decreases liquidity, and it takes us further away from those thresholds. So if we have long-term aspirations to be to rank among the Ritz and the Caledonias and so on, then we really need to grow as quickly as we can through compounding and not slow that progress through buybacks, which don't really work in terms of narrowing the discount. But yes, there isn't much better that we could buy from a pure capital allocation perspective than our own shares. But we don't know that does shareholders the favors that long-term compounding and achievement of scale gives us. In terms of our family group, so there is a concert party comprised of Luciano and me and our respective families and other members of the team, which owns somewhere just a little short of 30% of the issued share capital. That's the answer to that question. A concentrated portfolio does increase volatility and the risk of a large position disappointing. What are the areas of most downside risk in the investment trust, Luciano, in your opinion?
I think that in terms of risk, probably the Alphabet is one of the higher risk, high return positions, because unlike Microsoft, where you have a subscription base, it's more dependent on advertising on the search side. Over time, it will probably change, as you've probably seen that there's a lot of new subscription products that they launched, like the new Gemini Pro, YouTube Premium, and there's been very high levels of adoption on all of them. But unlike Microsoft and Amazon, where probably more than half of the value of the market cap you can subscribe it to the cloud business, where it's very sticky and predictable. In the case of Alphabet, the cloud business still represents a very small fraction of the portfolio. But at the same time, the valuation reflects that, and it trades at around 21 times core earnings, it will, which is not too different to what the S&P average is. So we think it's a much better company with much higher quality, and once the subscription business takes off, we probably think that the market will recognize that. But what we try to do is precisely minimize the risk. We think that the Airbus with 10 years backlog, Safran, which it's part of that thesis with the engines and the cloud growth in the next 10-15 years. The direction of travel is very clear with aerospace and technology. In the case of the infrastructure sector, it's more kind of a real estate asset. There's no operational leverage. You can get some levels of efficiency like we've been seeing with the railroads, but we're not going to see the same kind of increases, the operational leverage you have with the likes of tech and aerospace. But at the same time, it's essential public infrastructure. So we see very, very low levels of risk.
Yeah. To answer Damien's question, we haven't looked at mergers and so on. We want to just plow and furrow and do what we do, given that it's working. We've got better performance than any of the kinds of trusts that we would merge with, as well as a very different strategy. Some of the other green trusts have got small cap approach or developing markets, or they're doing impact stuff. As far as I know, we're really the only green investment trust which follows this Buffett school quality and value approach whilst delivering people exposure to this overarching theme. And so it doesn't really appeal to merge teams, merge strategies when no obvious strategic merger seems to exist. We would, of course, seek to grow by acquiring the assets of a smaller investment trust which is struggling, but no such opportunities have been forthcoming. Andrew has asked, do we trim and add to positions very often to rebalance the portfolio as valuations shift?
Not very often. It's more when there's changes in our views. Like we reduced Alphabet materially. It used to be a more than 20% position, and more than half of the 20% was profit. So we decided to halve the position after the large language models were launched by ChatGPT and OpenAI and other competitors. But we tend to keep positions for very many years. And in terms of the other trims, we trim a position as well when some of the private deals that we have, like the TCI Real Estate Credit Fund 4, for instance, we have agreed a allocation of $25 million. So at the moment, there's basically $17 million of undrawn commitments after we send a new capital increase of $2 million. So we tend to just basically trim when it's necessary, or we materially have a change of view. But that doesn't happen very often, precisely because of the nature of the companies that we select are very predictable and very low risk. Well, what is the upper limit on private investments in the portfolio? Theoretically, if you look at the prospectus when the trust was launched, it could be up to 60% approximately of privates. It was 30% were supposed to be yield investments, and which were supposedly they were private renewable deals in different jurisdictions, Europe and US, co-investments with at a kind of an OpCo level, and the other one was basically co-investments with private equities. We decided that we think that a 40% level is probably as high as we can feel comfortable, because we think that once you cross the threshold, people start punishing you with high discounts, which, I mean, we had such a low allocation now for privates, and our discount to NAV reached a crazy level of 40%. And what I think has happened is the fact that, the NAV has gone up, but basically there was like zero trading activity chasing that NAV. And that's the problem of lack of liquidity. Therefore, the best thing that can happen to Menhaden is like that liquidity on a daily basis increases over time, and there's going to be more actions, and therefore we think that that NAV will be tracked in a much better way than it currently happens.
So open-ending the fund. Of course, we talk about all these options the whole time. Should we merge with a larger trust? Should we do more ambitious buybacks? Should we take the vehicle private? Should we open-end the fund? These kind of strategic discussions take place the whole time. The beauty of a closed-ended vehicle is that it gives you this long-term perspective and an ability to embrace illiquidity, which you can't do in an open-ended vehicle. And that's how a number of open-ended vehicles have met a sticky end, is because they had a bunch of illiquid stuff, and then the cash calls hit all at the same time, and they weren't able to meet them. So we're not excited about the idea of open-ending the vehicle. We want to find a way to narrow the discount, and we think that's partly market conditions. It's partly achieving scale through compounding, and it's partly doing marketing, talking to investors like we're doing now. We're making a big effort to do lots of these webinars. We're meeting lots of investors. We were in Birmingham not so long ago, meeting wealth managers. And we've got a number of trips around the country, and we think the story is quite compelling. The quality of the underlying assets, the track record that we've achieved over a long period of time, and the discount, we think, combine to offer quite an interesting opportunity for investors. And we think if we can tell that story effectively and clearly, we think that should have put some upward pressure on the share price.
I think also that if you go to page 15, you will see our track record with privates, right? You'll see, for instance, just to mention ADO, which was a deal where we invested in Berlin real estate together with Apollo. And that came via the Goldsmith family office. And in this case, we paid 0 fees. It was not preferential terms, it was 0 fees. So I think that part of the value that Menhaden offers is this ability to modulate how big we can go in privates and publics according to when we see value. At the moment, we had a very successful track record. We got out of all the 4 deals that you can see there at very substantial IRRs and multiples of cash investment. In the case of other was like super short-term deal, but close to 30% IRR. And by open-ending the trust, you're not. It becomes just another open-ended fund that invests in liquid assets, and that, I think, if you have a long-term view, that's not a smart decision. I think similar questions all to do with discount, and the thing is, at the moment, it's not a question of whether Menhaden is viable or not viable. It's a question of whether the closed-end investment trust market is viable or not. You can see that the likes of RIT, Caledonia, Hansa, the dividend darlings of the investment trust universe, like Hickel and Bluefield, they're all trading at discounts of close to 20 to 30%. Despite paying dividends of between 6 to 9%, it's going to take time. There's no silver bullets. It's not paying dividends. It's not just buybacks. It's we think that we have to continue doing what we're doing. We're reducing the listed, putting in a very good private deal. We're looking at new private deals that offer very decent IRRs. and that's the best thing we can do. And eventually, when people keep seeing that the returns are meaningful, the market will recognize one way or another. Our performance is much higher than the likes that we just mentioned, right?
I'm really sorry. Sorry to interrupt. There's, I don't know if others can hear it. There's tremendous scratching noise or something on the interrupting our ability to hear.
Sorry, I don't.
I think it's your headphones, I think.
Yeah.
Okay.
Ben, Luciano, what I might do is I might just jump in there and thank you for addressing those questions from investors. And of course, the company can review all the questions submitted today and will publish their response on the Investor Meet Company platform. But just before redirecting investors, provide you with their feedback, which I know is particularly important to the company. Ben, could I maybe just ask you for a few closing comments?
Yeah, I'll just answer the final question. Is this trust the only one that we run? Yes, we are absolutely focused on this fund. I have a couple of non-executive positions in related areas, including my family's investment group. Luciano does nothing but this, and the same for Teddy Pybus. We hope that if you're an existing shareholder, that you'll consider topping up at this stage. If you're not a shareholder, that you will consider buying some. We are absolutely aligned with shareholders in that we both have significant chunk of our own investable assets in the investment trust, and performance has been great. Total expense ratios are coming down. You won't find another green investment trust that has this kind of performance or this kind of quality and value approach, and it's working. It's on everything that we control, it's working. The issue is the discount, which is an opportunity if you don't own any or enough shares yet.
Perfect. Ben, Luciano, I'd just like to thank you for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Menhaden Resource Efficiency PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.